Good day and welcome to the UTS Business School. My name is Gerhard Hambusch, and together with my colleague Dr. Kylie-Ann Richards, we are excited to welcome you, the audience, on behalf of the UTS Finance Department here at the UTS Business School to our event on ESG investing and related topics. Provided the current pandemic and Sydney lockdown, we hope that you and your families are well and safe. As a public university, UTS is committed to advance and share knowledge with impact with all our stakeholders. Today, we focus on selected matters that are undoubtedly among the most urgent problems that humanity is facing, including climate change. For this reason, we have invited several experts from Australia and overseas to discuss with us. I start with Mary Leung, who joins us today from Hong Kong. Mary is head of Advocacy Asia Pacific at CFA Institute, which is the world's largest not-for-profit organization for investment professionals with more than 170,000 members worldwide. Mary leads the team that is responsible for building market integrity in Asia Pacific by developing policy positions. Importantly, Mary is one of CFA Institute's experts on ESG investing. Next, we're excited to welcome Sheela Veerappan, who is the head of Australia and New Zealand at the United Nations Principle for Responsible Investment, or in short, UNPRI. Sheela is a manager research consultant with technical expertise in ESG risks, climate change and sustainable investment, working to evaluate sustainability and ESG risks in investment processes and decision-making. Next is Tim King, who is joining today's panel here from Sydney. Tim co-founded Melior Investment Management and is the firm's chief investment officer. Tim has worked in capital markets for more than 25 years, for example, for Colonial First State Global Asset Management and Deutsche Bank. Tim also serves as an honorary associate of the business school and has worked with us previously on ESG masterclasses and other events. RIA, the Responsible Investment Association Australasia, recently recognized Melior Investment Management as one of Australia's responsible investment leaders. Last but not least, we welcome Dr. Robert Waterworth, who is the CEO of the Mullion Group, an Australian-based and internationally recognized company with a core competence in greenhouse gas inventory systems for the land sector. Rob is a global expert in quantifying greenhouse gas emissions from the land sector and has deep experience in international negotiations, policy development, and program management. Rob has worked in academia and is experienced in working with global NGOs and the public and private sectors. Today's event will be facilitated by Dr. Kylie-Ann Richards, who is UTS's finance expert on sustainable finance and ESG matters.
Thanks very much, Gerhard, and thanks for the great introductions. We clearly have a fantastic lineup of diverse experience for today's talk. Now, before I begin, I will steal a minute from the discussion and just acknowledge Gerhard and the many hours that he takes to put into these events. He plays a key role at the UTS Business School in facilitating and accelerating our strong industry engagement. So thanks very much, Gerhard. Okay, so we've got a lot to cover today, and I'm sure there will be plenty of questions from the audience on these topics. So what we'll do is we'll start by jumping straight into the environment from ESG. So less than a month ago, an extremely important report on the physical science of climate change was released to the world. And my take on it simply was we're on track to true climate catastrophe. So, Rob, I think the best place is to start with you, given you're the environmental science expert on our panel. Could you start by maybe just giving a little bit of colour on what this IPCC report is, some key findings, and how that plays into the important discussions that will be happening at the UN Climate Change Conference in a month's time?
Sure, thanks, Kylie, and thank you very much for the invitation to speak today. It's a real privilege to get to speak to you all and to be on a panel with so many extremely talented people. But I'll kick off. The report that Kylie was just referring to is the sixth assessment report of the IPCC. As that may indicate, there have been 5 before this, the first one in 1990, and they've come out roughly 5 to 7 years spacing since then. A quick summary of the history of them is that right from the very first one in 1990, the statements were very, very clear that humans are impacting the climate. How much and the certainty around what was going to happen was lower, obviously, back in 1990. But as each report came in, those certainties got greater and greater and greater, and we've got to the 6th assessment report, and it's just so clear that it's not even a slight debate anymore. So it's been a really interesting journey watching that over the years. As Kylie suggested, that the assessment reports come in various parts. There's actually 3 working groups. There's one that looks at the physical science. There's one that's going to look at impacts and adaptation and vulnerability issues. That's the second working group. And the third working group is on mitigation actions. The report that was just released is on the first working group, looking at the physical science. Although really interestingly, a leaked version of the early draft from working group 3 on mitigation actually came out a few weeks ago as well. But those second parts are due next year. So that'll be really interesting when it forms into one consolidated piece of here's the physical science and here's what we can expect across the entire landscape. A really quick summary, as Kylie pointed out, is that we are going the wrong way and we're going very, very fast the wrong way. We've been looking to try to reduce emissions for a very long time. We really haven't succeeded. And that's meant that the amount of space left in the atmosphere really for carbon dioxide before we're locked to 1.5 degrees is not a lot. So there's a 50%, if we, at current rates, if we have about 460 billion tonnes available to us in space in the atmosphere, we'll reach that by 2030 or early 2030s. That's a 50% chance of reaching 1.5 degrees, 50-50. If you want to cut the odds a bit and say we've got a 2/3 chance of not reaching 1.5 degrees, then we've got to cut back. We'll use up our carbon budget in the next 5 to 7 years. So we really are rushing headlong at this now. I think a couple of really key points for me on this, though, are less around the degrees and really starting to think about and really communicate the issues of what does that mean. 1.5 degrees doesn't necessarily sound like a lot to a lot of people. But if you look at the impacts of that on extreme weather events and the environment, then it's really, really clear. So a really good one on this, and I've got some numbers here for everyone, is if you're looking at, say, a 1 in 50 year heat wave event, what was used to be thought of as a 1 in 50 year heat wave, at a 1 degree warming, they occur about 5 times more often. At 1.5, they come in at about 9. At 2 degrees, you're looking down the barrel of 14 times more likely. If we ever got to 4 degrees, then it's pretty much every year. It's coming up to 40 times more likely. So it's these extremes that are really, really going to cause the problems. And we're already seeing those, obviously, with, say, bushfires here and overseas. I think the net summary of it all, of course, is that the science is really, really solid. You know, there's 230 odd scientists working on this. There's 14,000 papers reviewed. The report itself's 4,000. So 4,000 pages of report. It's a pretty significant piece of work. And so realistically, that's where we're at. The other 2 key points that often don't get brought up, though, that I think are very useful for everyone, is that land and oceans warm at different rates. And so if you look at that, the land is already at 1.5 degrees. So the ocean is about 0.9 degrees warming. We're already at about 1.5 to 1.6 over the land. And that's leading to things already that, you know, you may not see in the news, but are going to be huge problems in the future. And you only need to look up, perhaps, say, snow gums in Australia and see the devastation being caused by climate change across a huge proportion of our forest areas in the Alpine. And that's a really great case example. So that would be a quick summary of the report, Kylie.
That's great.
I can jump into the COP stuff if you'd like.
Yeah, I think it'd probably be worth, I guess, the role the report plays for COP26, for those who don't know, is the shortened version of the UN Climate Change Conference that'll be happening in the UK shortly. I guess in terms of what that plays, well, the role that plays in terms of policy, and then I'll probably jump over to Sheela, and then we'll start leaning more into, I guess, the very key role that finance plays in this transition that's clearly, you know, I mean, there's no question from what you've just described as extremely urgent.
Yeah, so I think that the timing of the report's perfect because we are running up to the Conference of Parties number 26. As you may have guessed, that means there's also been 25 of those beforehand. That has really driven a lot of interest in this COP for the first time in a number of years, in my opinion, where people have really started to focus on understanding that we need to get some agreements in place to actually really drive emissions down. So the COP is largely a negotiating process between countries. Well, it is a negotiation process between countries. There are a number of issues that are on the table this year that have actually been hanging around for a long time. So the Paris Agreement was signed. that was basically a high level process. And for the past 6 to 7 years, it's now been debating, all of the actual ins and outs of that. And a number of key aspects, such as the international trading mechanisms under Article 6, issues of how do we finance all of this, issues of loss and damage for developing countries, how do you bring in nature-based solutions, land sector solutions, updating country commitments. All of those things are on the table at this COP. And so I think where this report's probably been really useful is it's supercharged the discussions to say we actually need to land these things. We can't spend another year talking about it and waiting. And so I think that we will see pretty significant progress in 2 areas. I think the Article 6 trading stuff will probably move forward. That will be really interesting. But the most fascinating part will be watching what countries come forward with their renewed commitments. So many countries are coming forward with renewed commitments to reduce emissions at this COP. Those commitments will basically determine whether we're on track or not. So.
Okay, that's great. Scary, but very, very insightful. Thanks, Rob. Sheela, I guess with finance being absolutely key in terms of the transition for our global economies, and coupling with your role at the UN PRI, so you get a very, I guess, good reach across asset owners, fund managers and consultants and many others in the investing community. How is the PRI responding to, in terms of their COP26, the expectations around what might actually come out of that?
Okay. So thank you, Kylie, for the opportunity to be speaking to the listeners today. So perhaps maybe I would start, because there's a lot of these acronyms floating around. I would start with what COP26 mean, or what does COP stands for. It stands for the Conference of the Party. And as Rob said, this is now the 26th times that the country leaders are coming together to address some very pressing climate-related issues. Now, particularly for this year's COP, the COP26, it has a very special significance because it's also the 5-year milestone since the countries came together and set their pledges, the pledges that we now know as the nationally determined contribution. So this year's COP is a rationing whereby countries have to put forward how they've been meeting those pledges. Interestingly, the developed countries have all pledged to increase on their emission targets, on their ambition, but unsurprising, Australia particularly has retained or reaffirmed its original target. So what are we seeing, or what am I seeing with the signatories here? So definitely the push to be meeting a net zero target, to have a net zero commitment now is realized, and the importance of that has to be filtered down, right down into every different stakeholder within the financial system. So while the asset owners understand and appreciate the challenges around, moving towards a net zero target, I don't think that messaging is really clear, particularly around the investment management industry. So a couple of areas that the PRI is working on to try and push this further, and we see policy as being that very strong lever, having a great and robust policy framework to encourage that transition to net zero is important. So the areas that we are working on is having a lot of discussions, particularly with the regulators and government officials, to try and move forward more quickly than what is happening right now.
And are there particular investor initiatives that you're seeing occurring, and also just in your discussions with the asset owners and fund managers?
So there are a number. I think part of the challenge right now is there are a number of different initiatives that's popped up. Each of these initiatives have their own framework or their own roadmap on how to get to net zero. The PRI has its own framework together with UNFFI, and that framework is for asset owners. So the one thing I can say is that climate change is an environmental issue, and you need to hinge it on science, and it has to be based on a science-based target framework.
Yeah, I guess one of the key aspects that often comes out is around, and it's not just sort of on the funds management side, but certainly on the corporate side, we talk about disclosure and that being quite critical in ensuring that there's an efficient and effective allocation of capital. And I guess, listening to Rob's discussion around where we're at in terms of how countries are tracking and, this tiny window we've got left, we really do need an efficient and effective allocation of capital to ensure that transition is happening very quickly. So I think I've seen that there's a lot of investors that are demanding for more information about ESG risks in their portfolios. So we're not looking so much at, so I'm not talking specifically at sort of disclosure on the corporate side, but the ESG risks that the fund managers are exposed to within their portfolios. And, that's obviously been driven by this explosion of interest in sustainable investing, but also for the things that we've just spoken about. And there seems to be a lack of standards. So this means that managers' disclosures tend to vary quite wildly. And, there's discussions or concerns around greenwashing, which we'll get to that shortly. Now, Mary, I understand that at the CFA Institute, they're proposing voluntary ESG disclosure standards that could be used by investment managers in terms of describing their ESG characteristics in their funds. Would you be able to explain what these standards are?
Sure. Thank you, Kylie, and thank you for the invitation to be here today. So for the CFA Institute, obviously we have been closely monitoring the developments around ESG integration and how finance can play a role. You alluded to the problem of greenwashing. It is certainly something that both regulators and the industry have been focusing on. And if anything, I think there's been intensifying regulatory scrutiny on the problem. And by greenwashing, what we mean is that investment products claim to be more green or sustainable or more ESG than they really are. And clients who haven't done who do not ask the right questions or haven't done the due diligence may be lured into a false sense of security because they think that these products deliver something that they don't really. And as a result of that, what CFA Institute has been doing is to look into developing a set of ESG disclosure standards for investment products. When we talk about disclosures, I think most people think about issuer disclosures, right? How the corporate's doing, what their greenhouse gas emissions are, what their water usage is, etc. But for a lot of investors, they are buying into an investment product, for example, an investment fund. So what can be done to help them understand and identify and compare across these products more easily? And this is the question that we're trying to answer. So in our draft standards that we published in May, and which was in the market for consultation for 2 months, what we're hoping to achieve is to articulate a framework in which investment managers can relay to the end investors on their strategy, on objectives, on risks, on what sorts of ESG information they incorporate, and how they do, and basically how their products are structured. Now, when we talk about disclosures, we started off with issuer disclosures, and you really need listed company disclosures before, before investment managers can have the right information to know what they're putting into their products. So we see this as a value chain of information. Increasingly, I think we are seeing the burden of information disclosures, not just on companies, but also on asset managers. So while our standard is global and voluntary, what we're also seeing is increased regulatory scrutiny and effort in asking asset managers to provide mandatory disclosures. So, for example, I think in a number of jurisdictions, banks, asset managers, insurance companies are going to have to comply with TCFD. And in the EU, they even go as far as having to provide both entity-level disclosures and product disclosures. Now, but not every market is at the same level of development. So we believe that having a framework that can apply uniform globally, that's voluntary, will help investors in identifying the products that they can and comparing across the products that may best suit their needs.
Yeah, I think it's definitely a trend. There is the burden of information with disclosure, I think, on both sides of the fence. We're seeing here in Australia the regulator APRA is requiring insurers to report on climate change risks, so physical risks, liquidity risks, transition risks. So there is definitely a move that way. I guess one of the challenges with developing these global standards, and particularly in this context is the, I guess, the confusion around global policymakers' response to ESG, and that's probably, that comment's probably further inflated given the COP26 that's coming up. What's the CFA, or what's your view on that, with that still developing, but at the same time producing these standards?
I think that regulators worldwide are very focused on the issue. So if you look at IOSCO, they've already, I think, set up 3 work streams within the members, and IOSCO is the international body of securities regulators. And they've set up work streams to look at ESG rating agencies. They've set up work streams to look at disclosure. And globally, there's also an IFRS effort to harmonize accounting standards, or the provision of non-financial ESG related information. So I don't think the regulation is going to let up. But that said, I think there's still a lot that the industry can do to raise the level of trust in the system, because ultimately this is a question of trust. You want your end clients to know what they're buying into, and to have the comfort and the confidence that what they are buying into would deliver the impact or the objectives that they are seeking to achieve.
Yeah, I think it's something that people probably don't give a huge amount of thought to, and maybe it's assumed, but without the trust in the financial markets, they don't function. So, if this is key to, transitioning and so on, it's absolutely critical. And part of that is very much disclosure. So, Tim, I want to move to you for a moment. So as an impact investor, and I guess what might be described as truly a sustainable investments, and I'd be interested to hear about your experience in essentially walking the talk on standards for sustainable investing, and what you see the challenges and opportunities are.
Yeah, thanks, Kylie. Thanks for the invitation. Nice to be here. The first point is it's incredibly complex, and Rob and Sheela talked about climate and COP, and clearly that's really important, but it's way more complicated than that. And if we just look at the E, so to speak, the issues around water and waste and biodiversity, and then we move into the S and we think about diversity and inclusion and First Nations people disadvantage and poverty and safety and gender, and then we go into the G and think about boards and are they fit for purpose to govern and strategize over this? How do they manage it? How do they compensate their executives? I mean, it's just immensely complicated. But that's the first point. And as Mary just said, that there aren't any standards. It's not like financial reporting, right? So my overall assessment of that is companies are really struggling. But I think in general, trying to get their head around it. I mean, I'll give you an example. Yesterday, I was speaking to quite a high-profile board director. He sits on 3 large listed company boards. He's chairman of one of them. And I said to him, how are you thinking at TNFD? And he said, what? So do you mean TCFD? So Task Force on Climate Related Financial Disclosure, as Mary just talked about, which came out of Paris. And I said, no, TNFD. And he said, I don't know what you're talking about. And I said, well, that's Task Force on Nature-Related Financial Disclosure, which is being developed now and is talking about basically creating a similar sort of framework for how should companies measure and report and think about how they account for biodiversity, right? And so for him, that was just like, well, we've barely got our heads around TCFD, let alone thinking about TNFD. So there's always some new dimension in the ESG space, and for companies that's super complicated, right? And then if we go down the vertical, it's and think about emissions. So I just came off a call just then with a pharmaceuticals company, and they've sort of just got their head around Scope 1 and Scope 2 emissions. And then we started talking about Scope 3, and they made the point that 80% of their emissions are Scope 3, and it's just so complicated because how far down the supply chain do you go, and how do they don't even have the data, right? So it's multidimensional in its complexity. So that's a real problem, and there's a big education session required in educating companies and other stakeholders in terms of understanding all that. But just to conclude, the way we think about it in terms of managing a portfolio, there's massive alpha generation opportunities here to generate alpha in the portfolio, and that's basically for two reasons. Number one, the way we think about investing, if we invest in companies that are providing products and services that help solve for the problems that the UN Sustainable Development Goals show up. So if we can, for example, invest in a health company that solves problems around healthcare, well, there's clearly massive tailwinds in terms of capital will flow into that sector, right? Because we need to solve the problems. And if those companies do it in a sustainable way, in other words, they have good ESG credentials, that's a huge risk mitigant because they're going to have less reputational risk, less legal risk, less regulatory risk, less policy risk. And so out of that, you get a more resilient company, right? And that's certainly been our experience. We've been going for more than 2 years. We've outperformed significantly. And the academic evidence, the likes of George Serafeim out of Harvard, shows that those sort of companies will outperform through time and generate superior returns. So there's no trade-off required. You can do good and generate superior returns.
I think also we did have a question from the audience about insights on some risks involved in ESG investing from a company's perspective and how they could be mitigated. I think you probably covered some of that off, Tim, but maybe I can direct that one towards you.
Yeah, sure.
So,
well, if we just look at the last 12 months, the number of CEOs who have lost their job in Australian listed companies from ESG issues, right? Think Rio Tinto, Duke and Gorge. Think of AMP. Well, you know, the list is so long there in terms of ESG issues. Think Crown, you know, regulatory risk, poor governance. Think Cleanaway, inappropriate behaviours. Think PBE, all those CEOs lost their jobs. That involved significant reputational damage for those companies. It involved governance changes. It involved negative consequences for share prices. So the risks manifest themselves in different ways, but they have very real consequences for the share prices and the financial outcomes of those companies, either through fines, through loss of market share, through whatever, right? So there's very real linkages and a lot of examples.
One other question I wanted to throw your way, Tim, before I go to the next question on the Q&A, is that just bringing this back to reporting as an impact fund. So you'd be no doubt sort of, you know, gold standard on impact reporting, demonstrating what the carbon footprint is of your investments and so on. With regards to the way you as a firm, you and your firm approach that, do you think that's something that's easy to replicate across all funds management businesses? Because I think this sort of ties in a little bit to the standards that the CFA, if I'm correct, Mary, the CFA standards disclosure that's currently under review.
So we think about it in a, as somebody said, they weren't going to use acronyms, and so I won't either. So SASB, Sustainable Accounting Standards Board. So we think about it in a SASB matrix materiality, right? So I'll give you an example. Examples are easier here. So, you know, for a pharmaceutical company, they typically have to do animal testing to test products. We know that it's just part of the way they have to develop their products, but that has to be done in a responsible way. That's a material ESG issue for that company, but it's not going to be a material ESG issue for a utilities company because they don't test on animals. It's going to be emissions, right, or something else. So understanding materiality is key. But because there's no standards, that's really complicated. But I think the bigger issue here is lack of data. So if we go back to say scope emissions, many companies don't disclose their scope 3 emissions because they don't know what they are, because they haven't done the work to understand what they are. But there's ways and means of estimating that, because we can kind of work out through supply chains what that emissions profile would look like, so we can estimate that. But for example, if we look at ethnicity or gender, we can't guess that, right? That's impossible. We just don't have the data. So that's just a void. It's a vacuum. We don't know. So it depends on what the issue is and whether we can estimate it, but there's lots and lots of data gaps. That's a real problem. Yeah,
I think the data is definitely a key discussion when we're talking about greenwashing, and I will come back to that. I just want to make sure that we get some of the questions from the audience. So there's a question here about, which I'll open up to the panel, jump in if you wish to answer. So my understanding is that net zero initiatives is supposed to be for 2030 instead of 2050. And if organisations and governments say they want to achieve net zero by 2050, could we say that's too late, thus their policy is greenwashing?
Do you want me to kick off? Or?
No, whoever wants to jump in, go for it. I don't want to hog this, but I'll just go for it.
I'll just go for 1 minute. First of all, it comes back to the same policy. There's no standard about net zero, right? So when you see net zero, it's like, well, what do they mean by net zero? So some companies will say net zero scope 1 plus scope 2. Some companies will go scope 1 plus scope 2 plus scope 3, but then you look at the details, it's only operational scope 3. So it's just the flights. So it misses all the supply chain scope 3. And then other companies like BHP is talking about the full suite of scope 3, but how they, I won't go into the complexities of that, right? Because that's complex in itself. So first of all, there's no standard. That's issue number one. But the general consensus of the science is we need to be net zero by 2050 and right into half that by 2030. But I would say the greenwashing comes in as to what does the company mean by scope. What's in the scope, right? So if you look at, say, South 32, it's net zero by, I can't remember the date, but it's scope 1 and scope 2. Well, 95% of their emissions are scope 3, which are clearly somebody else's scope 1. So the devil's in the detail and understanding what they mean by scope, as well as the date.
So I think I'll circle back to Rob on this one, given he's quite an expert on greenhouse gas emissions. And this is actually a bugbear of mine as well in terms of the use of data and the complexities of the environmental data. Would you be able to give a little bit of colour on those complexities, on measuring and on reporting, and how that might translate to, I guess, problems for the finance industry when we like to take numbers and plug and play? Your speakers, you're still on mute, Rob. Yep.
Yeah, sorry, yeah. Yeah, look, and I agree with everything that Tim just said, basically, that the scopes are a huge problem. The other problem I think you find with net zeros is how they're achieving the net zero. So everyone says net zero by 2050, but if you look at the graphs going out, you need to look that we actually need to go net negative post that. So there's actually a bigger problem post 2050 that we've still got to achieve. So a number of the impacts or the thoughts on a lot of these net zero commitments at the moment are offset first, then start looking. And that's the wrong way around. We need those offsets to start thinking about how we're actually really going to ratchet down. The old offsets world of 10 to 15 years ago, in my opinion, is largely gone. And we definitely need to use land-based stuff and offset, don't get me wrong, but the whole idea that you can just keep emitting and purchase offsets everywhere is not really there. So it's very much a how do you reduce first and then use what little you have left after you've done all those reductions. So that's probably point number one. Yeah, on the data, it is complicated. It really depends on the type of organisation you are too. So some organisations it might be very simple for, especially where you're just using, say, energy, and you have a good system that says, well, we know our energy comes from a brown coal-fired power station, for example. It's much harder when you start getting into things like, land sector stuff in particular, which we focus on, mainly, sort of agriculture, forestry, things that are spread all over the place. You've got multiple products coming off the land at different times that may or may not have been deforested. You have all of these tracking issues where you have large amounts of product going into a mill. So you don't actually know of those products, which ones were sustainable, which ones were not. It's a really fascinating chain to build. Having said that, I think it is actually solvable. And the key part is to actually make a start. So one of the problems we typically see is it looks so confusing that no one does anything because they say the data's not good enough. And as you would know with anything, you basically just need to make a start and start to improve it. And I think that's where the world's starting to head. The new technologies that are coming on board, I think, are really helping. You have these remarkable new sensors and you can link up to Internet of Things and some remarkable new software. You have satellite tracking. These things are all coming online very, very fast. The main challenge, I would say, is how do you systematize that, automate it, and then get it to the people that need it. And they are the three big steps that are the big challenges remaining.
Okay, that's good. Now, just onto another question from the audience, and this is kind of pulling all the pieces together. It's a great question. So if we think about all the developed countries, Australia has the poorest standing on climate. So I'm just sort of trying to summarise the broader discussion that was on there. Standing on climate, including the absence from, say, the COP26 talks. So in short, Australia is shaping up to be the villain. Is it possible for industries and companies to reverse this before November? Now, I think this is a really important point, because I think it was the end of last year, if I have it correctly. So Sweden's actually started divesting out of state bonds in Western Australia and Queensland. So investors are seeing this, the writing's on the wall. So we are already having an impact at that level in the Australian market. And of course, this will flow into companies as well. Maybe Sheela, if I can sort of bring you into this discussion, what are you seeing in terms of your I guess, discussions with the investing community around Australia in particular, and the challenges that they're facing with regards to, sort of, I guess, our poor standing on climate?
Yeah, definitely at the national level, it's not very encouraging, but I take, some faith that our signatories particularly are taking these issues seriously, and they are trying within their own means to work towards a net zero commitment, whatever shape or form that takes. I think just also going back to the discussion on timeline, while 2050 is the ultimate, investors here are breaking it down. They're breaking it down to chunks, like 2030 will be that gap where they take stock of what they've done. I think something else that needs to be appreciated is the risk that you're going to be introducing to your portfolio when you start investing into other asset classes or into these renewables. So ultimately, it's all about the risk and return trade-off that investors need to be mindful of. So while divestment seems to be the easiest and some perhaps even the cleanest approach, you still need to be mindful that that risk of that particular company or even of that particular coal mine still remains in the system. So divestment might not necessarily be mitigating the risk, the climate risk that we're all trying to resolve here. What would also be helpful is to have stronger, clearer, and firmer policy direction from the regulators. I think that would probably set a clearer pathway for everyone, particularly here in Australia.
Okay. Yeah, I agree. So, and I think it's, that comes back to that policy regulation discussion we had earlier with Mary. Tim, I think a quick question for you from the audience. So is doing good and still generating superior returns actually empirically supported in an Australian investment market context?
Well, I could point to our performance.
Yeah, I was just thinking, because it's Australian focused holdings.
Yeah, so we're benchmarked against the so we don't have any special ESG benchmark. We're benchmarked against the ASX 300. We've outperformed by 1,800 basis points since inception of the last 2 years, right? So when we launched, there were lots of naysayers saying, no, you're going to underperform because doing good results in underperformance. So that's been our experience. And as I said before, there's a pile of academic evidence, particularly out of Harvard, which Sarah Feynman, out of the business school, Colin Meyer, which supports the notion, and it makes logical sense, right? These companies will have lower cost of capital because, as Sheela said, there's issues for companies in terms of attracting capital. Are banks going to want to lend to companies that are exposed to all its ESG risks? So, as an example, so there's issues around, those companies that don't have good ESG credentials will tend to have difficulty attracting capital, will probably have higher cost of capital, and are faced with all these ESG risks in terms of regulatory risk and policy risk and so on. So, and then I think we keep talking about risk. There's enormous opportunity out of this as well, right? I present. This is actually a company we don't invest in. It's actually a fast food company. That's the reason we don't invest in it. We would argue that company's inversely aligned to these, particularly around good health and nutrition. But the chairman reached out to me and said, "I'm getting so many questions about ESG. Can you come and present to the board?" Right? Because we don't have any ESG reporting. So I presented to the board, and they produced their first ever sustainability report a couple of weeks ago. And it's far from perfect, but at least it's a start. And he phoned me and he said, the response from our staff has just been so overwhelmingly positive that we're actually on the journey to help address these issues. So, that results in what, being able to attract better talent into the staff, being able to probably lower staff turnover, better contentment about working. So, right, there's a positive to that too, right? And there's other positives like that. So it's not just about risk mitigation. So, and then there's been a lot of broker research from the likes of Morgan Stanley and so on, which support this notion as well. So there's lots and lots of research out there to support the idea that this style of investing should create superior returns.
Yeah, I think the discussions a number of years ago were sort of more around question mark on performance, but certainly a risk perspective. But I feel the dial has most certainly shifted on that in recent times. So
and for companies, right, Kylie? Yeah. It's clicking with boards. This isn't like something we reluctantly have to do to tick a box. It's like if we do this properly, we can create a more resilient business.
Absolutely. Just sort of, I guess, bringing Mary back into the conversation around, we're talking about sort of just from one of the questions from the audience about Australian companies and whether they're required compulsory reporting on ESG, carbon emissions and CSR. And I guess perhaps more generally, whether are companies in key markets required to report on ESG parameters? So I think the reason, if I have it, maybe I've misplaced this, but the CFA had some involvement with the GRI, so the Global Reporting Initiative, which I think is one of the frameworks that corporates report against. Is that right?
I mean, we do work with other financial reporting standard setters, but we don't have any formalized relationship with them. But yeah, I think that's a great question. Right? I think Tim talked about the lack of data. Where does the data come from for asset managers to be able to do their work? And that has to come from companies. So that's why we were talking about the value chain of information flow. I mean, the data is by no means perfect, but I think it's actually gone a long way. And I think the four letters that will probably be around with us for a while is the TCFD. So I think many more companies will be either voluntarily or be told to report according to TCFD requirements, which may include some of the greenhouse gas emission metrics that we've been talking about. But if we look at the EU, I mean, they are having so many EU ESG regulations that are coming online. They have taxonomy, they have the non-financial reporting disclosure, which is now being upgraded to the corporate sustainability reporting disclosures, and require companies to produce reporting and consider things like double materiality. And then you have the SFDR, which is the Sustainable Financial Disclosure Regulation. And it's targeted at the financial services industry. So again, the taxonomy provides a kind of dictionary, a catalog, and defines what makes something sustainable. A company will look at that and decide the proportion of its revenue that's sustainable. And then once that disclosure is made, then the asset managers will go away and incorporate it into their own analysis and into their own disclosures. So you can see how that's flowing. It's quite complicated, but this more disclosures are I think a good thing. Sunlight's always the best disinfectant, but I think also investors, the end users, need to be better educated. I don't know if many people will actually find these things useful, and how there's going to be a big effort in raising those the average knowledge level, and allow investors to better do their due diligence and understand what's behind some of these disclosures. After all, a metric is just a number, and it needs to be set in context before you can really appreciate the opportunity and the risks.
So at this stage, do you think for a number of corporates in this, I guess for what we're talking about here, it's more a box ticking exercise and the real improvements are yet to come? Or do you think that there's actually, we are seeing real improvements?
I think we are seeing real improvements in some sectors and some of the larger companies, because obviously the larger companies are the ones with the most resources to devote to this. But that's not always, that shouldn't stop anyone from making a start on this journey. I think for this thing to get real traction, we need to kind of look at this as a win-win-win proposition. Mm-hmm. So obviously there's a market element to it, right? Like again, like Tim said, if you do this right, it's an opportunity. It allows you to lower your cost of capital. It allows you to diversify your shareholder base. And so it's good from the commercial sense. So that's a big take. And the second motivation would be from regulatory perspective. Probably less so in Australia, but in other parts of the world, we're seeing regulators stepping in to require or to mandate disclosures from issuers. And so, for the most enlightened issuers, they will see that as an opportunity. Some of them will just see that as a box-ticking exercise. But, in whichever way they look at it, if they do this, it will help them achieve their regulatory obligations. So that's another take. And the third take would be that, well, actually, this is the right thing to do. So if you can think about it as a win-win-win proposition, you meet your commercial market objective, you meet your regulatory compliance objective, and it's the right thing to do. I think that's where, you can see real traction and real change in behaviors.
I guess on the topics of disclosure reporting, and maybe I'll sort of direct this towards Sheela to begin with. We'll take a slight digression to the topic of modern day slavery. So we've recently had the introduction of the Modern Day Slavery Act, 2018, I think inception in 2019. I mean, reporting on this area, supply chains identifying modern day slavery, must be incredibly difficult for corporates. And now they're required to, above a certain size in Australia, at least, in the UK and a few other countries. What's the perspective with regards to, I guess, ESG policies, Sheela, with regards to modern day slavery?
So, corporates say that some of them have very complex and lengthy supply chains. So it's really very hard to understand where the risks lie. And our view on this is that as a corporate, you need to earn your social license to be operating. So for you to not be aware where that risks are, it's not a valid excuse at all. In terms of the regulation, it's been helpful to put this regulation in place. But what the conversations that I've been having and I've been listening to, it's, there's a fear that this might just end up being a compliance exercise rather than a real opportunity to address some of the changes associated with modern slavery, like, creating a safe and decent working environment for employees.
I guess, Tim, from your perspective, what sort of recent developments have you seen, or I guess how do you view this from your perspective when you're looking at particular companies to invest in?
Well, as you said, Kylie, it's legislated, right? So companies with more than 100 million turnover should report under the scheme. So that captures a lot of companies. But once again, the devil's in the detail. It's like that net zero where I said, not all net zero is created equal. It's the same with modern slavery. I mean, you look through the submissions are all public. You can see it on the Border Force website, and some of them are really detailed with detailed plans of how they're going to address modern slavery and and identifying the risks and so on, and some of them are rubbish, right? So, you know, sort of, I think to Sheila's point, they've just done the box ticking, get it out of the way and hope no one looks at it. But the problem is that the people like us who actually bother to look at it. And so, you know, those sort of companies are going to get found out. So I don't think there's anywhere to hide here. But once again, it's a massively complex issue along with all that other suite of complex issues. And I think it comes back to, is the board of the company equipped with the skills and knowledge to actually understand all these issues? And I would think most boards aren't. And number two, do they have the talent in the organisation to actually implement the policies and discovery and procedures to address all these issues? And once again, most companies aren't. That company I gave the example the other day, just before, the fast food company, suddenly the company secretary became head of ESG, right? Well, like literally, and it's like that person has no knowledge of this, but they don't have anybody else in the organisation. And thirdly, because there's a limited amount of, every company is looking for these sort of people. There's a talent shortage as well. So it's immensely complicated.
So there's a question from the audience still on this topic in terms of how do you convince someone, it's an excellent question, so it could be a board member, a senior executive, that fighting modern slavery needs action now. I mean, this is one of the ones that, discussions that I've had with one particular asset owner, we're talking about modern day slavery, and from an investor's point of view, we want to know what's financially material. But this is one area where it's not, it's just simply illegal. So it doesn't fall into that same camp. But then how do you convince them? And I think that this is kind of to the point of how do you actually convince them that fighting modern slavery actually, this needs action now?
Well, my experience is, the good news is there's no convincing required. I've never had an argument, or frankly, I've never had an argument with any director about whether any of this right across ESG is important, right? I never get into the argument about that. Where it gets to is that they are just overwhelmed with the complexity of all the issues, and they don't know where to start, right? That's the problem. So the good news is I think they all recognise that there's a moral imperative to do good, but if they don't get it right, there's immense risk in the system, right? And also there's an opportunity cost, right? Because if these, say you look at modern day slavery statements, that they're not fit for purpose because they're publicly available, they're going to be exposed, right? There's huge, at the very least, reputational damage from that, and that's going to have consequences for the revenue line of the company. So directors are really worried about it. There's no convincing required. Just how do they go about it, solving the problem?
And I think this is core to the disclosure topic as well. It's kind of, are we cherry picking information because we, for companies, they don't want to be exposed. They don't want to be exposing their risks in a way, appear to be transparent, but at the same time still hiding what the core risks are. And that's, I think, a big challenge if things, if these disclosure statements or frameworks still remain voluntary as opposed to regulation. So just looking at a couple of the questions from the audience. So it seems as though most of the carbon reduction efforts are focused on energy, transportation and agriculture. Do you agree with that statement? And how much value would you put on focusing or diversifying our efforts on other more niche areas of carbon reduction? So does anybody want to jump in for that one?
I can, but someone else might want to go first.
Yeah, thanks, Tim. I can jump. Yeah, I mean, yes, that's where most of the emissions are pouring out of. So when it comes to the energy sector, especially obviously from coal, but also the transport and agriculture sectors are huge. There are other sectors of industrial processes, for example, but yes, you need to tackle all of them, basically. There's no way you can leave any of them off the table. I think the nichest areas of carbon reduction are really how you do it inside each one of those. So what does it look like to be reducing emissions from energy in different countries and different areas? And that's going to be a really interesting challenge because there are a wide range of possibilities that need to be applied. So the answer is, yeah, we do need to focus on those, but we need to go fast, and the big ones are where the wins have to be made.
I guess this brings back the discussion around divestment. If we think about stranded assets, cost of capital, Sheela, have you got any thoughts or around these topics in terms of these heavy carbon emitters and divestment?
Can I just refine the question in terms of whether is your question in relation to divestment being an effective tool to reach net zero?
Yeah, so we could start with that. Yep. Yeah.
So in short, it's one of the tools, but it's probably not the most effective, and it shouldn't be the tool that you look at first, right? We believe, especially in the PRI, that engagement with the companies is just as important, or perhaps even more important, along with policy regulation. Because as I mentioned before, divestment means you're just passing on that buck to someone else to resolve the issue, to resolve that risk. The risk ultimately is still within the financial markets.
Okay, I think we're actually getting close to the hour. I'm sure all of us could talk about these topics for many days without stopping. I do want to thank you all for joining the panel. I guess some closing thoughts. So we think about whether finance can address the most important problems in the world, which it's very clear we're facing those right now, and whether finance can carry its weight to help address not just climate change, but also very important topics like modern day slavery and sort of other pressing problems. Now, what I'll do is I'll hand back to Gerhard just for closing remarks.
Many thanks, Kylie. We are, of course, mindful of your time, that is the audience time, and hence allow me to thank the audience for having attended today's event. Importantly, we would like to thank our panelists who have shared their expert views. So allow me to say on behalf of the UTS Finance Department, thank you to Mary, Sheela, Tim, and Robert. A big thank you to Kylie for driving the bus today, so to speak. A recording of this event will be provided within days. Please visit our YouTube channel to find this and other event recordings. And allow me to invite you to find and follow us by searching for UTS Finance on LinkedIn and Twitter to stay in the loop with research and other events shared from our side. We wish you a great day, a sunny day in Sydney, and stay safe, and we will see you at our next event. Thank you very much.
Thank you.
Thank you. Bye-bye.
Thanks, everyone.
Thank you, everyone. Bye.